And it also is very competitive. There's hundreds of different managers out there. I remember when I started at Mackay Shields, we were 89 out of 91. And within 3 years, I was very proud we got to be number one. But that's a lot of people to compete against. And you get your scoreboard every day. But more importantly, strategically, there was the mindset of why do people buy, why do they sell, and can you front run that? Can you predict if the premise, if you're thinking of investments as maybe as short movies, and how's a movie going to end? And if your premise is if this happens and this happens, who am I going to sell it to, and why are they going to buy it? And so, part of that could be liquidity. Part of it can be the stats. Why isn't somebody going to buy the 4 times levered software company that's growing at 11%? Sure, they're going to be upset that they didn't buy it at 20%, but it was 5.25 or 5.5 times leverage back then, and the mindset was different. So I think that, and if that looks attractive, for instance, just using an example, to what else is in the market that's yielding 10% or 9%, there's going to be enough takers in that. So having that mindset's always been attractive and helpful. There's also the, you look at something like COVID, and okay, how are people going to behave? There was usually, I remember, in mutual funds that when people got redeemed, they would sell what they could sell quickest, or what was most liquid. I always tried to sell my semi-liquid product because I know I could never sell it in another week if this continued. So there's just different strategies to think about.
So if you fast forward to now,
yep.
At Golden Tree Asset Management, how do you perceive the mentality right now in the masses or in the funds that you go up against?
Sure. So there was a bigger question. We were talking just a few moments ago about the perspective on credit, particularly total return credit. And there's probably frustration because some other asset equities are participating significantly, and credit, broadly speaking, is in the low single digits. So there's frustration and anxiousness. How do I capture returns? Against that backdrop, you have great current yields and still value when you subtract out versus defaults that justify being in credit.
Just to have everybody participate, this is a great time to bring in our question, which is how you're positioned in credit for the remainder of this year. And I would love for you all to weigh in, defensive, neutral, or risk on. From your perspective, how are you positioned? I mean, right now, do you want to take more risk? Are you looking for yield, or are you looking for defense ahead of greater opportunities?
So when we spoke in January at Davos, I mentioned how the setup was poor for credit and good for equities. Historically, when you've had stretch valuations in a mid-cycle where the economy is expected to grow at 2% or better, your returns in credit are less than the coupon. And that's exactly what's happened so far. In contrast, usually that's a great environment for equities, and that's what's happened. And even if you look at the equal-weighted S&P, it's certainly beginning to catch on. So it's been a more broader rally, particularly the last few weeks, even in the face of Iran on-again, off-again conversations. Credit has still languished, and we expect that to continue. Now, that's not to say that it can't have a better second half, but I do think there's some pockets of opportunity. But this is historically a tough time to be in credit in terms of in this cycle.
Because of inflation and growth that doesn't really benefit the instruments.
It's just how it's priced. It's priced as if defaults are going to be low, and that the corporate earnings are going to, and that they're more likely to disappoint. You're not getting paid to increase corporate earnings or for earnings to surprise on the upside, and you're being heavily penalized if they surprise on the downside. In the equity market, there's still some acceptance or excitement if you're taking up numbers.
There are some opportunities, like you said. Where's the distress? Where are you finding them right now?
So it's very situational. There's the expected distress, which is in software, where the business model is getting called into question. Then there is also in telecom, another business model that's getting called into question. And there is an interesting relationship between the public equity. As you look at a Comcast, I think that's hitting a new low as we speak, a 52-week low. If not, it's certainly close to that. Charter's probably in the same camp. Cable One in the same camp. But yet some of the debt isn't. So I think that's kind of an interesting relationship. The debt and what happened, I guess, recently with Altice, with threatening a transaction. I think it's all a ploy for negotiation, but it probably brings people to the table sooner if it works. It's the same team that brought you Bausch, and we respect them an awful lot, but it kind of went nowhere when there was a bunch of I guess, potential transactions being contemplated that didn't get to the finish line from the equity.
So playing the debt equity structure in creative ways is one way that you're playing with it.
Right, and within industries. I think the equity in cable is much easier. It's hard to see that the equities don't work, don't work, and the debt works. So I think that relationship's kind of interesting. I'd say the same thing in healthcare, which seems like it's been a source of funding for technology stocks. And there are certain companies like Tenet, which strike me as very reasonable value. Sure, there has been some volume issues, but the valuations seem very credible, top-notch management team, and I think the equity market, the credit markets would finance the entire market cap.
More broadly, you started by talking about the frustration felt by a number of credit fund managers, because right now, this isn't an asset class that tends to work that well or give that many, that give outsized returns, given the scenario we're in. And yet people are pouring trillions of dollars into AI infrastructure. Does that worry you, excite you for the potential down the line?
Well, when you look at, the devil's in the details in terms of what the terms are. But when you look at who's backstopping it, they seem like good credits. And people tend to think of 2 and 3 years out, not 5 or 10 years out. And it looks like for 2 to 3 years out, you're getting overcompensated for the risk. On the other hand, you're dealing with terrible technicals. They don't seem to run out of product. And I think even this Google financing is suggesting that they want to make sure to be out in front of the financing in terms of the equity. And there's almost, or not almost, there is an arms race going on. And the issue is, will the infrastructure investment be justified, or will this be more like underwater cable, which was a good thing until it wasn't?
Do you have a take on that? Are you embedding a sort of thesis into your investments?
I'm somewhat agnostic, but history would have a bad record in terms of overinvestment for industries that have very high payouts, whether it's riverboat gambling to something like undersea cable. So, it's not a great precedent, but there's an argument that, I understand the arguments now, and I think our view is to be very deliberate to have additional assurances by the users that they're committed to these projects.
Would you rather invest in the high yield part or the investment grade part with the all-in backdrop, the idea that it tends to be lower duration, shorter maturity in the high yield, but higher risk, investment grade, longer duration, but tied to very reputable companies?
So my guess is at different points in this funding, you're going to get high yield type of spreads in the investment grade market. So the issue is, what you do in between them. So I think it depends, on the pricing, but I think you'll get in at least every other stretched or overfinanced industry I've been part of. You usually have been able to get excellent protection with below investment grade pricing at some point. So now, what do you do in between there, is the issue. But it's going to get there at some point.
So you just dance in cable and pick up some distressed software and wait to invest in this area until it falls out of bed?
No, because if it's 2 or 3 years, that's a lot of return to give up. But to be deliberate about what you're getting versus the opportunity of what you might be getting. And Lisa, I'm incredibly fickle on these topics, so I could, in a month or two, could just have a different perspective with more evidence.
How do you remain nimble at a time when you're going in and out of sometimes less liquid instruments?
First is you got to assume you can't be nimble in less liquid instruments. And lower prices brings in illiquidity, higher prices brings in confidence. So that's kind of the way the credit markets work. Just trying to ask as many questions and focus on what we think are the key variables. In something like AI, you can be overwhelmed by so much. So to try and look at some of the larger issues and just focus on that and be deliberate. Because there's so much supply, the idea of you're going to run out of opportunities isn't a real, that's not realistic. There's going to be something to do in this space, particularly as it continues to be successful.
Right now, would you rather be in public securities or private securities, just as a rule? I mean, in terms of the interest, the demand.
So when we look at asset classes, probably the asset-backed asset class, we find the best value, which is a private asset class. So we're finding good value there. In private credit, there's some of the more anxious capital, the open-ended private credit funds, are out of the market. So that leaves the funds and other players in private credit who are more deliberate, being the main buyers of private credit. So we're seeing good value there. We're seeing good value in some of the out-of-favor sectors, which is always the case. I mean, by definition, out-of-favor sectors are at discounts. But so I'd say it's eclectic, but we certainly are seeing better value in private credit today than we've seen in the last 24 to 36 months.
Are you getting paid for the illiquidity premium?
That's always after the fact comment. But it seems like you're getting better paid. In the absolute, when I think of things, I think it's, if I were to say out of 10, maybe a 6, 6.5. So it's above average, but not by much.
Right now, we're looking out for a year where a lot of people keep talking about inflation and inflationary risks, and this is one of the reasons why credit hasn't been as much of a sweet spot. How do you price that in? I mean, at what point do you just start to increase the sleeve of equities and create some protection on the downside and kind of hope for the best with a couple of security selections?
Inflation is probably the biggest risk in the market. And it's impacted, because it's impacted rates, much more credit than it has equities, which I'm surprised at, but it just is what it is. And if you look in the 70s, there were equities did better than credit. So, if you're looking at a bad environment, at least that's one example where equity outperformed credit. It's very much data dependent. It's also what's going to happen with the war. If you look at one of the big surprises so far this year is oil has been relatively calm in relative to what expectations. Most people thought if you got past Memorial Day, it would be 125, 135, but yet we're in the mid-90s. So I think it's that's a factor that seems to be developing. So it's hard to have a line to draw a line in the sand on that.
This is cognitive dissonance every single morning. We talk to a lot of people, and we were speaking with Mike Wirth of Chevron the other day. And he said, we're going to end up with shortages. If this keeps going, in the next couple of weeks, we could start seeing shortages in the United States. Diesel inventories are at the lowest level since 2003. And then you get an equity strategist on, a credit strategist on, we're not looking at that. That doesn't matter. How do you think about that?
So I kind of process it a little different, is how are equities pricing this? And equities seem to not be pricing the futures curve. So on the strip curve, it's just, so oil service, sure, Halliburton's having an excellent year, but when I look at some of the mid caps, very much pricing in, I'd say $70 to $75 oil. And when we see the M&A market in oil services, and we have a company that we own more than half of that looks at the M&A market and has bought a few companies in the past 12 months, and that market hasn't changed that much. So in terms of levels and pricings and multiples and expectations. So we see regardless of what people are saying, how they're voting with their feet, they're still very cynical of how long this will last. And that's probably, it seems like a better opportunity that it's going to be higher for longer than what's in the market.
So in other words, buy mid-cap oil names.
Yeah, and suppliers, but also when you're thinking about oil as an input to your companies, I'm thinking as a portfolio manager, okay, what should we be assuming in terms of whether it's in building material products and which oil can be an important input. What does it mean for inflation, et cetera? My guess is going to be higher for longer.
I want to pull up the results to the poll, and unfortunately we didn't have an answer to the poll of just frustrating. But the answer was, how are you positioning credit for the rest of 2026? Not for ultimate frustration, but neutral, 42%, defensive, 31%, risk on, 27%. Does that surprise you?
So I look at it as almost 75%, 73% of people who are like, yeah.
What else can you say?
Yeah, and so it seems about fair. What's a strategy that's been very popular this year in terms of inflows is opportunistic credit, having a long playbook, and instead of a distressed manager, a private credit manager, how about a manager who can look for the best opportunities with a long playbook? So that strategy has been gaining a lot of traction. I think the positioning and credit in terms of getting alpha and dispersion that's not surprising with the results here.
You've been in the business for decades. You've seen a lot of cycles. You were talking earlier about the 70s.
Yep.
I hope that's not the analog. But is there an analog to the moment that we're in right now that you can think of in terms of investing, in terms of the macroeconomic backdrop?
So we're mid-cycle in a stretched environment where it's very narrow for what the opportunities are. That's like most markets I've been in. I mean, that's like just...
Doesn't feel like most markets for most people.
But so, if you were to go back and count, stretch valuations, very little dispersion except for a certain percentage of the market, call it less than 20% of the market. That's kind of most markets. I bet it's 3/4 of the market is what that is. It's certainly more than half.
So you think that the analog is almost every time except for the big extremes?
Well, I think that what's different this time, because every cycle has something that's different, and what's different this time is the AI expense and what the ramifications of who the winners and losers are. And you could have said that with media, with the internet, and who's going to be, when I think of software, and try and conceptualize who the winners and losers are, I look at legacy media. And there was TV, which went from, call it nominal growth to less than nominal growth, but still growth. You look at cable programmers who still had above nominal growth for about 15 years. So those were healthy businesses. You had radio that, call it by 2008 or 9, seemed to really be a more marginal product, and then by the late teens, really in trouble. And then you had newspapers, which really peaked about, I'm trying to think of the Tribune transaction of 2006, 2007. I'm going to think 2005. So after 2005, really began to be disintermediated. So where does some of these industries fall with that methodology? Fascinating.
And everyone wants to be not radio. Although radio is coming back with podcasts, so there's that.
Although it's not on the band, right? So when you're thinking about radio, as I grew up with it, it was AM, FM, and really FM for the most part. Although I think I remember being invested the largest creditor in MS, which was WFAN on the AM band. But it was, but that's it's a different medium for radio.
Yeah, different distribution mechanism. Stephen Tananbaum, always a clinic, always wonderful to speak with you. Stephen Tananbaum of Golden Tree Asset Management.
Thank you.